6, 7. So you are 8. Desmond.
Some of them are not having light. That's why.
They are not
having
light.
Yes.
Oh, sorry. Desmond, I think I want one of you to read the thing and let's see. So let's go. Let's go ahead. We are just looking at statement of financial position today. Let's go ahead. Who is available?
Sir, please, I'm here. Statement of financial position. So the balance sheet is a financial document that shows a business's total assets, liabilities, and capital, and how the assets are financed, either through debt or equity. It can also be referred to as statement of net worth or statement of financial position. The balance sheet follows the fundamental accounting equation, which states that asset equals liability plus equity. A business statement of financial position, that's the balance sheet, is a list of ledger balances arranged according to whether they are assets, capital, or liabilities, and also shows the financial position on a specific date. Below is an example of a balance sheet format.
Okay, that's okay. So over here we have seen the various names of a balance sheet. Is that correct? So we realize a balance sheet is the same as statement of financial position. It's also the same as statement of net worth. Is that okay?
Yeah.
Hello.
Hello, sir.
Are we together?
Yes, sir. We are
Yes,
together.
Yes.
Okay. Now, so we have added one to it. So we have statement of financial position, balance sheet, and then statement of net worth. Okay. Now we were told that it is basically outlined on the accounting, on the fundamental of accounting equation. And then we know the accounting equation to be assets equals liability plus capital. Is that correct? But we have bypassed that. We know about that already.
Yeah.
So let's look at the format or the layout of a typical statement of financial position, which is in this layout. Now, you see, you just assume that the XX, they are figures, okay? Now, in our previous studies, when we look at the financial statement, I told you that the balance sheet is divided into 3 main components: assets, liability, and equity. Then I said the assets are also divided into 2 main components: the fixed assets, which we also call the non-current assets, and then current assets. Are we together? You can write. I'm saying that the fixed assets or the assets are also divided into 2. We have fixed assets, which is also called non-current assets, and then current asset. I think I have to be sure you are understanding what. Good. So we are first saying that the balance sheet is made of assets, liabilities, and capital or equity. Okay. Then we are saying that assets we also have fixed assets or non-current assets. And then we have current assets. Is that okay?
Yes, sir.
Then we also have the liabilities as follows. And so the first two, the liabilities, we also have short-term, long-term. We have long-term, short-term, and then the current liability. Now, I want to explain something about this one. These two are also referred to as non-current liabilities. These two. Yeah. Is that okay? All right. So this is what we are trying to say. Now, the long-term liabilities, they are liabilities that they are the liabilities that last more than let's say from 2 years upwards. So let me put it in a simple English. Like if you are owing somebody The money you pay within 1 year is what we call current liability. The one you pay within 1 year is current liability. The one you pay from 2 years going is what we call the non-current liability. Now, the non-current liability, depending on how long it will take, it could also be classified as medium term and then long term. So let's say at least something from 15 years going should be long term. Is that okay? So if you take a loan today, the portion you pay this year, the portion you pay this year is an expenditure to you. The portion you pay next year is a liability to you. The portion you pay from next 2 years going is a non-current liability to you. Does it make sense? Hello?
Yes, sir.
Are we together?
Yes, sir.
Okay. So what we are saying is that the balance sheet is made up of the three significant things. And so we have the assets, the liability, and then the capital or equity side. Then we are saying that the asset side has also two sides. The first side is either fixed asset or non-current asset, is the same name. And then the current assets. Now, the fixed assets or the non-current assets, when we say fixed assets, they are the tangible things, the things that you can touch, you can see it. They are the fixed assets. Is that okay? But then there are some assets that you can't see with your eyes, but their financial values are attached to them. Example is like your goodwill. Goodwill. When we say goodwill, is the good name of some company or the premium on that company. For instance, if someone want to sell Hyundai company to you, and then another one also want to sell Toyota company to you. In Ghana, we know that Toyota has a stronger brand to Hyundai. Is that not it? Or I'm not using a good example. Hello, class.
Yes, sir.
Sir.
Yes, sir.
Don't be quiet on me. You know, we are not seeing each other. So if you respond, then I know that you are there. So the premium or the importance added to the company aside the product is what we call goodwill. That adds to the value of its thing. You see, when you go to market to buy certain things, let's say some fridge or air condition, they are the same thing, is the same thing you want. But because of the brand name, the name of the brand is assumed that some are more durable or more quality than the others. What that means is that that company has a good name. And so a value, an amount is placed on that value. So when we say the goodwill of the person or the company, it is not something, it's an asset, but it is not something you can see with your eyes. But it could be valued. Is that okay? So what we are trying to say is that the assets could have a non-current asset, which may not be tangible or could be tangible. Just bear that in mind. Then under the asset, we also have a current asset. Current asset, they are those assets that can easily be turned into cash. They are those assets that can easily be turned into cash or quickly be turned into cash. So current assets, cash itself is current asset. Bank balance is current asset. Your debtors, you can easily collect your money from them. They are also current assets. Is that okay?
Yes.
Yes,
Uh-huh.
sir.
So those are the classifications. So let's go back to the I just want to draw your attention to these things, then we go back to it. So now we see that the balance sheet is fundamentally based on the accounting equation. So that is what makes it a balance sheet, and it shows your state of affairs or your financial position at any given time. Now, when you come under assets, we said motor van. These are the type of assets that are fixed assets. Motor van, building, fixtures and fittings. Those fixtures and fittings on your premises, like your ceiling and those things, those are the things we call fixtures and fittings. And then the premises, you could look at furniture. Furniture is also one. You can look at land. Land is part of its assets. Then your goodwill, which you can't see with your eyes, but it's also part of your fixed assets. Then when we come to current assets, we said there are things that you can easily change into cash. And we have your stock. If you have some things in store, that is your stock. And then receivables are people who are owing you. People who are owing you. And then provision for doubtful debt. If you have made some provision that some people will not come and pay, it doesn't mean they will not pay at all. It's also part of your money. Is that okay? Then your money at bank is also a current asset for you. And then the cash you are holding is also a current asset for you. Then if you pay somebody in advance, if you make any payment in advance, that money that you have made in advance is also your asset. For instance, you live in somebody's room, you rented it for 1 year, but you've paid 2 years advance. The 1 year that you pay is for the current year. The advance that you pay is for the next year that hasn't come yet. And that money, the advance, is your asset. You can decide to collect it at any time. So it's part of your asset. And that is what we call prepayment. Advance payment is what we call prepayment. Is that okay? So what we're saying is that when you add all your fixed assets, then you add it to all your current assets, it should give you your total assets. Fixed assets or non-current assets plus your current assets should give you your total assets. Is that okay? Now, there are circumstances that affect your fixed assets. Circumstances that affect or conditions that affect your fixed assets, which leads to the reduction in value of those fixed assets with time, is called depreciation. Depreciation. Is that okay? So depreciation is as a result of various factors. One, your asset may be depreciated as a result of its usage. The more you are using it every year, it will reduce in value. An asset can also be depreciated if its fashion can be outdated. If its fashion can be outdated, let's say the TV you buy today might be an analog TV. Maybe you bought it 10 years ago, but now we have digital TVs. So you see that it has outdated. The fashion has come down. It cannot it cannot perform like today. So you want to reduce its value by some amount every year, so that amount you are reducing it will show the amount of loss or the amount of usage you have used it for the past period. And so if you have any fixed asset, you think about its replacement. How will you replace it if that one, the number of years you want to use it, if that year has passed, how will you replace it? And so you try to quantify the usage value. You tell yourself, okay, if I use it every year, then I will reduce, I bought, take it that I bought the thing 100,000 and I want to use it 5 years. So if I use it every year, I'm taking it that I've used 20,000. So every year you are setting 20,000 aside from your profit as usage of the thing you have, the assets you have used, and you charge it against your profit and put it aside every year 20,000, every year 20,000. So after the 5 years, you had recovered your 100,000. That is what we call depreciation, reducing in value of an asset due to its usage. So when you see something here like ACC dip, what it's trying to say is accumulated depreciation. Accumulated depreciation. And the NBV is net book value. Net book value. So all we are saying here is that your fixed assets, the cost at which you bought it, is the price at which you bought it the day you bought it. It may reduce. And so if it reduce, you charge depreciation again. Every year you charge depreciation. Is called, when you put it together, becomes accumulated depreciation. And then when you subtract the depreciated value from the cost at which you bought it, you get the net book value. Is that okay?
Yes, sir.
Good. So we are saying if you put all those things together at the end of the year, you put all those things together at the end of the year, then your total assets minus total accumulated depreciation will give you the current book value or the net book value of your fixed assets. Then you add your current assets to it. When you add your current asset to it, then you can get your total assets. Is that okay?
Yes, sir.
Now, there is also what we say that our current liability. The current liabilities, they are the people and the things that we are owing and we would have to pay within 1 year. And those things are accounts payable. One, accounts payable is when we buy something from somebody on credit and we haven't paid. We promise to pay in a year. It's part of our accounts payable. Expenses owing. if you make some expense and you haven't paid fully, for instance, you make rent and you haven't paid fully, or electricity, you haven't paid, you are owing it, you have to pay within the year. It's all called your current liability. Now, any money you have received, but you have not worked for it, any money you have received, but you have not yet worked for it, is also a current liability on you. For instance, somebody come and put 2,000 with you that, oh, you have been doing his hair or you have been selling iron sheet. He's giving you 2,000, keep it for him. Next year, you will come and buy the thing. Once he hasn't come to buy it and you have collected the money, sorry, the money you collected is your liability. If you get missing, the person will come and collect it. And once the person is collecting it within next year, is your current liability. So that one too, you have to account for it. Now, when you subtract your current liability from your current assets, then we call it as what? Working, your net current asset. Is that okay? Now, when you add your current asset to your fixed asset and you subtract your current liability from it, we call it your working capital. Your working capital. Yeah. Then when you take your, I think my first explanation was wrong. When you take your current liability from your current assets,
Hello. Hello, sir.
Please, can you hear me?
I can hear you now.
Yes, we can hear you now.
But there was a point you could not hear me.
Yes, sir.
Yes, sir.
Oh, okay. So let's go back. But you were seeing my this one.
No,
My,
your screen too went off.
my screen too went off.
Yeah.
Yes.
Oh, maybe it was network. Okay, so let's go back to my screen. What I was trying to explain is that we have total assets is equal to your fixed asset plus your current assets. Is that okay?
Please, still, we can't see the screen.
My screen is still not showing.
Yes, sir.
Oh, okay. Is it showing now?
Yes, sir.
Okay. So what I'm trying to say is that in the balance sheet, we have fixed assets, and then we have a current asset. Then we have current liabilities, and then non-current liabilities. I hope you got all those things.
Yes.
Okay. So I came to give some illustration here. Then I said, fixed assets plus current assets will give you your total assets. Do you get that side?
Yes, sir.
I think we lost this side.
You lost this side.
Yeah.
Okay. So let's come back to our format. We said that we have fixed asset that comprises the things that are tangible and some are intangible. But the fixed assets, they are those things that the properties of the organization. Now we have the current assets. They are those assets that you can easily turn into money, cash. They are called current assets. And we made an example of stock, your debtor figure, the receivables, your bank, your cash, any prepayment, and all those things. Is that okay? So we're saying that you have a liability, and the liability too is those you were owing. And the liability can be classified, those you are going to pay within 1 year, they are called current liability. Those that you'll be paying more than 1 year are called non-current liability. And I said the non-current liability could be a short term, a medium term, or a long term liability. And those ones too, I said, all the people you are owing and you'll be paying within 1 year, they are what we call your account payables. And then expenses that you are owing, like your rent, electricity that you have not yet paid, they are your expenses that you are owing or outstanding. They are also your liabilities. Then if someone has given you some money which you have not supplied the things to yet, or you collect some money from somebody, you haven't provide services yet, is also a liability on you. So we said, if you add your fixed asset to your current asset, you will get your total asset. Is that side okay? That side. Then I also said, if you take your current assets and you subtract your current liabilities from it, then you get what we refer to as your working capital. Is that okay? Now, if you subtract your current assets or your current liabilities from your total assets, then you will get your net asset. Is that also okay? Yes. Okay. All right. In other words, it's like when you add your working capital to your total asset, fixed assets, your working capital, when you add your working capital to your fixed assets, then you get net assets. Okay. Then we came to the equity side. And I said, equity is the source of funding you have used for the business. The capital or the amount you have used to start the business. And I said that there are various forms of getting money to start the business. If it is loan, then we call it debt. And those could be in the form of a debenture where you'll be paying interest on it. But if it is shares, then we call them equity. That one is money that came in to start. It's not a loan you'll be paying interest. They are investment monies that you pay dividend. When you make profit, they will share together. And so that one is called equity. Equity capital. Is that okay? Please, are you getting it? Hello?
Yes, sir.
Yeah.
What is the difference between equity and then debenture from what I've said? Can someone explain? Hello, class? Or I should repeat it?
Yes, I repeat it.
I'm saying that the money you use to start business is what we call capital. Are you okay with that?
Yes, sir.
But the capital can come in different form. If it come in the form of a loan, where you will be paying interest, then we call it debt capital. The capital is in the form of debt. It means it's a loan. Debt is a loan you'll be paying interest on. An example of it is debenture, what we call debenture. So debenture is a loan. It's a loan, a short-term loan that you can use for business. You pay interest on it. Is that okay? But if it comes in the form of money that interest will not be paid, but when you make a profit, then you share, then we call it shares. And that is called equity. Equity holders don't receive interest on their investment. They receive what we call dividend, their share of profit. But debenture holders, they are form of loan givers. They receive interest on their debenture. So they receive a percentage interest on their loan. Is that okay?
Yes, sir.
So we are saying the capital side depends on the type of funding the company is using. It could be equity, which is shares, and it could also be a debenture. So this is how the balance sheet looks like. This is how the balance sheet looks like. So when you take this balance sheet, you see that from the top, the immediate top is fixed assets. Fixed assets. And the total ends over here. Then you see current assets starts with stock and also end somewhere. Then if you decide to add the fixed asset plus the current asset, then you will get a total asset. Is that okay? Then you come to your current liability. The total will end somewhere. If you have a long-term liability, then the total will end. Then if you add the two, long and short, you get total liability. When you subtract your total liability from your total assets, you will get net assets. Then your net assets minus, or your net assets should be equal to your capital. Okay, when we take an example, hello,
Yes, sir.
have I went off again?
Yes, sir.
Yes.
Yes.
I went off.
Yes,
Yes.
sir.
Please, anytime I went off, let's find a way of letting me know, because I'm tired of the repetition.
Okay, sir.
Uh-huh. So at what point did I went off? At what point were you off?
You are the asset part.
And what was the last thing you heard about asset?
It's a question about the debenture and equity.
Okay. So the explanation on debenture and equity, did you get it?
You were about to explain and you went off.
So I said that debenture is a form of a loan used to start a business, and you pay interest on debenture. But shares are a form of equity which you don't pay interest on. Rather, the person share profits. Is that okay?
Yes, sir.
Good. So what we are having is that a balance sheet, let's say if we have a box like this.
Your screen is not showing.
Okay. Is it showing now?
Yes.
So what we are saying is that the balance sheet has a principle like this. If this is assets, then it should be equal to let's say this is your liability. And this is your capital or equity. Okay. So let's say this is equal to, and this is plus. I'm just trying hard to see if I can get a way to explain. I can get a way to explain this principle for you to understand me. Are we together?
Yes, sir.
Are we
Yes,
together?
Yes,
sir.
please.
Okay. This is what I'm trying to depict. Good. What we are saying is that your assets should be equal to the monies you are owing people. When you add it to the money you yourself you brought into the business, should be equal to your assets. Does it make sense?
Explain again.
I'm saying that this equity is the money you yourself you brought into the business. And the yellow one is a liability, is the money you borrow from people or the things you credit from people to start the business or to be doing the business with. And we are saying that if you add these two together, it should give you all the properties that the business is having, or all the things that the business is having should be given to you by what you brought in and what others have given you. Does it make sense?
Yes, sir.
Please, does it make sense?
Yes, sir. Yes.
Once you understand this equation, everything in the balance sheet become easy. What we are saying is your assets, which is represented by A, is equal to your liability plus your equity. So if you are given any of two, you find the other one. So this whole one, oh, God help me to get this thing for you. So if you take this box, you take this box, or this is the asset we have, and you subtract this is just a minus sign, right? Is it showing? Can you see?
Yes, we can see, sir.
I'm trying hard to see if we can be on the same page. Do you agree? Do you agree on this? Looking at this. Looking at this, do you agree on the down one?
Yeah. Yes, sir.
Do you understand this?
Yes.
What we are saying is that your asset is equal to the money you owe people plus the money you brought in. So now, if you have your assets and you know the money you owe people, then you can now get the money you brought in. Any of this, when you change it, you can get the other one. Is that okay? It's just an equation. It's just an equation you can just manipulate and know. Find maybe if L is not there and you are giving A and E, can't you find it? Hello?
Yes, yeah.
Okay, let's do an exercise. I'm not getting the feedback I wanted. If A is equal to L plus equity. As for you, Gra, you are IT people, so your math is good. So can't you find say L if A equals 6 and then E equals say 4. Find it. Let's see. Can you do it? Hello.
Hello, sir.
Online is painful. Can you see it? Eh?
Yes, sir.
So so find the liability. Liability will be what?
2.
Will be 2. How did you do it is my concern now. How did you do it?
So the liability, you maintain it in front of the equal to sign.
Mm-hmm.
So it's like L is equal to 6. Then you bring the 4. The 4. So the 4 crossing the equal to sign, it will change to negative.
Mm-hmm.
So it will be 6 minus 4, making 2.
That's all. Do we all understand?
Yes.
Yes, sir.
We've all understand. So that is the principle. So once you know that in accounting, assets, once you know in accounting this equation, once you know this equation in accounting, the rest of the thing in the balance sheet become easy. Do you understand?
Yes, sir.
So all we are saying is that the balance sheet always should be balanced by this equation. In every balance sheet, this equation plays an important role. So don't forget this equation in accounting. You don't forget this equation in accounting. It's an accounting equation forever and ever. So let's go back to our uh, example that we want to do. And I said one person should read this. Read it from number 4. Let's finish this thing in some 2 minutes, please. Who is reading, please?
Oh.
Ayiram. Is the lady there? She's disconnected.
Okay. Can I read?
Yes, go ahead.
Analyze the information below which relates to GTP Enterprises as of June 30th, 2026. Using the template you have created, prepare a statement of financial position. So the capital is giving us 25,000, cash
Mhm,
12,000, accounts
mhm,
receivable 9,000,
mhm,
inventory 15,000, office
mhm,
furniture 7,000, Net profit of the business is 10,000. Accounts
Mhm.
payable is 5,000. Bank
Mm.
5,000. And creditors 8,000. So the question again is to analyze information below which relates
Okay.
to GTP enterprise.
So let's look at this. When you look at the equation, this one is the capital. The cash, where does it fall?
Asset.
Which part of assets?
Current asset.
Account receivable, where does it fall?
Asset.
Which part of the asset?
Current asset.
Inventory, where does it fall?
Asset.
Which part of the asset?
Current asset.
Office furniture, where does it fall?
Asset.
Which part of the asset?
Non-current asset.
Correct. Now, the net profit falls under this one, capital. I didn't speak about it. That's why I pick it out. The non-current and the net profit is part of what? Capital. Okay.
Yeah.
So let's come. This one, account payable. Where does it
Liability.
fall? Where does it fall?
Liabilities.
Liabilities. Which part of liabilities?
Current liabilities.
Bank balance. Where does it fall?
Current asset.
Creditors. Where does it fall?
Current liabilities.
Very good. So now let's use this information to prepare the name. What's the name? Let's use this information to prepare a balance sheet. Okay. We were given the name as GT. We were given the name as what? GTP Enterprise. That's the name of the company, is that not it? So we prepare our statement of financial position as at, were we given a date? 30th June 20x6. Okay. Then we said what? Fixed assets. What is our fixed asset in the team? Are we together? Hello? Hello, class.
Hello. Hello.
Hey. Have I cut again?
So you are on.
Our fixed asset, the fixed asset inside this question is this one. Okay. That's the fixed asset. And the amount is how much? 7,000. Then you can look through and see whether you have another fixed asset. There's no other fixed asset. So we have our current asset. Our first current asset is what? Inventory. Inventory is the same as what? Stock. And the inventory is how much?
Inventory is 15,000.
The next one is what? The next one is what? Account receivable. Account receivable is the same as debtors. Okay?
Yes, sir.
When you see debtors, it's the same as what? Account receivable.
Okay, sir.
Mhm. And how much is it? How much is it?
Account receivable is 5,000.
Account receivable is
Sorry,
9,000.
9,000. 9,000.
Then what also falls under current assets? Bank. How much is it?
5,000.
And then what else? Cash. How much is it?
12,000.
So we have actually taken this. We have taken these two. Let me show this one separately as because it is fixed asset. So let me make it red. Okay. Then we also took this one. Are you following me?
Yes, sir.
Okay. Always you bring your CD sign. Okay. Then our next thing is what? Current liability. Okay. So from here, what are our current liabilities? The first one is what? Creditors. Our creditors are also our liability. Okay. How much is it? Then we have accounts payable. Account payable, there are people we are owing.
Mm.
Okay.
Yeah.
And how much is that? 5,000. This is account payable. Okay. So we have dealt with this creditors. We have dealt with accounts payable. We are now left with only two. Now, so you just add the total of this one. And the total give us what? This gives us the total. So we are saying that there are several methods of presenting it. If you want the total assets, then you can add the fixed asset to the current asset. It will give you total assets. Do you understand? So you let me go that way and explain to you. So we have this to be our total asset. Okay. Then this is our liability. Is that not it? This is our liability. Is that not it? Now, when you add these two, will give us our total liability. So let's say total $13,000, right? This is our total liability. And we are saying that if you subtract the total liability from your total assets, then you are going to get what we call net assets. Are you okay? Are we okay? Then the capital
Yes, sir.
side is what we call the financed by. So we are saying that this business is financed by. How is it financed? One, we saw capital. Is that it? We saw capital. Capital of how much?
The capital is 25,000.
So we saw a capital of 25,000. And then we had some profit. Net profit brought forward. How much was it? Are we all following the team?
Yes, that's 10,000.
The net profit brought forward is how much? 10,000.
Mm.
Is that correct? So
Yes,
it will give us a total of what? It has given us a total of 35,000. So it is this 35,000 is the same as this 35,000. Then you said you have balanced it. This figure and this figure. This is where this is the balance sheet or the statement of financial position. The explanation we have given in all we did from beginning is just to arrive, get understanding to this principle. Is that okay? Is that okay?
yes, sir.
So this is our statement of financial position. Yes.
Can you please go over current liabilities again?
The current liability. We said the current liabilities, they are the people we are owing and we needed to pay it within 1 year. So from the data they gave us, we were told that creditors are 8,000. We're told that creditors, yeah, they are 8,000. So it's here. And then we're also told accounts payable. They are people we are owing. And people we are owing and we need to pay. It's the same like creditors. The difference between these two is not big. So they are also 5,000. So we pull it together and our total liability is what? 13,000.
Yes.
Good. So we take our total liability from the total asset, which is this. And it will give us this. Our net asset is this. This one, we call it net worth. How much net worth? How much the company is this in it. So the amount put into the company is 25,000 as capital, and then 10,000 as profit brought forward from the business itself, and that gives us this. Now, when you do this and it is not the same as this, then it means your thing is wrong based on the accounting equation that we look at earlier. You remember? So where will I get that? This one, based on what we are doing here. Have you seen? So what we have done now is just telling us that it was here. Okay. We did it even just under it. What we are saying now is that from here up to here, this box, I hope I am not confusing you more.
Please.
Sorry? Are you?
No,
Let
you are
me,
not confusing us.
is that?
I said you are not confusing.
Okay. So, what we are trying to say is this place, and this place. So this is the asset part. This is the liability part. And this is the capital side. Do you understand the accounting equation now? So even if we were not giving the capital, assuming we were not giving capital, this figure, this 25,000, assuming we were not giving, can't we find it? Hello?
Yes, we can.
It says,
As you see, the thing is based on a principle. that your assets should be equal to your liability and your capital. So whilst we were preparing the balance sheet, we were able to get all the elements. I'm looking for the question. We were able to get all the elements from the question. This statement they gave us. We were able to get all the elements from here. Now, assuming that this part, capital, has not been given to us, assuming this capital was not given to us, this particular capital, how do I color it? I've used almost everything. So assuming this capital was not given to us, when we come here, we can deduce and know that the total we were supposed to get here should be equal to this plus this. So if this plus this is not adding up, then we can do it. This minus this plus this will give us this. So this minus this plus this, and then this is giving us 48,000, and this is giving us 35, and this is giving us 10. When we add, it will give us what? 45. Is that it?
Yes.
No. This is 13. This is 13. 13 plus 10. It will give us 23. So what this means is this. 48,000 is equal to is equal to 13,000. Oh, why did my hand touch it? It's equal to 13,000 plus 10,000 x, something like this. You see, this is what we are likely to have. Or no, it should not be 10,000 x. It should be 10,000 plus x. 10,000 plus x. Is that it? But we are looking for only one variable. So it's 10,000 plus x. Please, assuming, what we are doing now is assuming there is no capital given in that question. And when we cross this will become what? 48,000 minus 10 plus 13, 23,000 is equal to x. And this will give us what? 25,000 is equal to x. So if that is what we are looking for, then when we put the 25,000 here, our answer should be correct. The thing should balance. Have you seen? Please, are we okay? Hello?
Yes.
Hello.
So basically, where we were supposed to end is just here. And the boxes should not be in. I'm just trying to explain with the boxes. All we want to do is there was nothing. This is the statement of financial position. Okay. This is what we were asked to do. And I'm just trying to show us that this portion is the asset portion, This portion is the liability, and this portion is the capital section. Is that okay? Any question on this? Any question? Hello?
Yes, sir.
Any
Yeah.
question, please?
No, please.
So we understand this one, right?
Sir,
Yes.
are you going to send it to us as part of our slides?
I think I should send it to you so that you know what it is.
Yes.
Yes,
It should be
sir.
sent to you. But I don't know if these top things too should also be sent. Should it be sent?
Send everything, please.
Okay.
Send it and demarcate it because our lights are on, off and on. So we leave
So
the
what
class and join again.
So what you do is that when you go through the thing, you will see examples I was making are also on that. The examples I was making, BIT. The example I was making are also on the same Excel sheet. Is that
Okay.
correct?
Yes, sir.
But the solution is what is added down. Now, what we did is just a small thing. But usually, you see the account, that solution that we solved, the solution we solved the last time. Hey, what we solved the last time, like where we prepared the financial statement,
Yes.
the statement of financial position, income statement. A question could be given to us fully like that, and then we'll be asked to prepare the statement of financial performance and the statement of financial position. And so I think the next time we meet, we'll take one question and do the two things. The first one and then this one. This is the first one that we did, the income statement. You remember? This was what the lady was asking the question earlier.
Yes.
We were given a trial balance to prepare this, and we prepare from it. They can also ask us to use that same trial balance to prepare this one. And this one doesn't come, we don't need expenditure in the statement of financial position. We only need the assets, liabilities, and then the capital. Is that okay?
Okay.
So at least up to this level, you people, you are introduced to the ledgers, the day books, the statement, income statement, and then the statement of financial position. So the next time we meet, we'll try and then take a question that will give us both. If there's no question, then I think we'll bring the class to an end. Is there a question?
No, sir.
So go through this document. I've shared with you. This document, I'll share it with you. Go through it. And then when we meet, there are things inside we can use. For instance, this question. We can use this question, extension. We can use this question to do the two. You see, they have asked the two. They say, given this, prepare income statement for the year ended this, and then they say prepare statement of financial position. So you can try your hand on it. Okay? You can try your hand on this.
Yes, sir.
And see whether you can. The only thing I didn't talk about is the drawing. The drawing is when the owner removes part of his capital that he has put into the business. And the capital, you see the capital is here. So the profits that we added there it was given to us there. But when you come here, you see that we find a net profit over here. So this profit, if the owner want to take some money out, he should take it from this one. So you send this one. You send the capital. When you send the capital like we did here, you send the capital, and then instead of adding the net profit direct, you bring the net profit here, and then come and subtract the drawing from it. Drawing is the money the person took for his personal use. So you come and subtract it from it, and then you add it to it. Then you get your total worth. Is that okay? So you try your hand on it and see. This equipment is fixed asset. Furniture is fixed asset. Land, fixed asset. Electricity is an expense. Rate, expense. Bank overdraft is what? Current liability. It's current liability. The drawing is what I just told you what to do. The rest are all what we learned. Thank you very much.
Thank you too.
Please, are you people there?
Yes, sir. Please, we are here.
I noticed the thing has cut again.
Yes.
So I was saying that try the next question on that sheet and see if you will be able to be okay. I'm always available and you can always call and ask questions. I wish you well for the day. Thank you.
Thank you too. Bye.
Okay.
Thank you, sir.